Hello, my friend. Welcome to the True Secret Sauce series. Let's discuss trading plan. If you are working on a hedge fund or in a large corporation, probably you have a written trading plan. This trading plan is carefully analyzed, vetted by a supervisor, back tested before it becomes a workable plan. Even with all those trading plan, what's happening to the hedge funds and active managers? Their performance has been mediocre. Now, think about a retail investors like you and me. 99 out of 100 people do not have any trading plan. Yes, they will be trading some underlyings today, some strategies tomorrow. When there's a loss, they just wrap up in fear. And that's the norm with the retail trader. You should have a trading plan, and that's one of the important criteria in managing risk. When things work fine, yeah, everything is good and you don't really need a plan. But when things go wrong, if you have a trading plan, you can analyze what went wrong with the trading plan and fix the trading plan rather than complaining about what went wrong and what you should have done and doing all the guesswork. Here is my written trade flow guide. Okay, I just start with I'm basically an option seller, and so I just capitalize on time decay. I verify if theta is 0.1%, which means if you have 100k $100,000 of net liquidation, your time decay should earn you about $100 a day. If the IV is low, go a little lower, like let's say 75 or even 50, and on a higher end about 150. So between 150 to 150, and make sure it is at about $100. This translates to, assuming everything else remains the same, about $3,000 of earnings in time decay. Let's say my theta has dropped down to a point where I have to trade. I will look at delta to vega ratio. In an ideal world, we should have as an option seller, you should have a mild bearish bias, so you should have a mild negative delta. When I say delta, it's beta weighted delta. In this case, if you look at it, my beta weighted delta is a positive 20 in this paper account and vega is negative 12. So basically I will be doing good in this market if the stock prices are going up. Generally my preference is to have a delta that is close to 0 and not have too much negative or too much positive. So if this delta to vega ratio is, let's say right now if I look at it, it's about 20 positive delta and negative 12. So which means I'm long. My next trade should be ideally something that is short. So this delta gets down to negative or close to 0. If let's say my delta was negative 100 for example, and the vega is let's say negative 12, then that means I'm too short. I will have to add a long rather than a short. So this is what it is, delta and vega. You can just add with these tabs and that will help you to keep your balance. So now with that, if I want to do a long or short, I just look for a 45 days to expiration options and then trade it. How do I manage? Even if the trade goes against me, if it's 21 days or more, I generally don't try to do anything unless it's an iron condor where I can pull one side little bit in. But once it gets into the 21-day mark, Usually 21 days of Friday, so I'll just wait till Monday or Tuesday, and if it's break even or above, just close it. And if it is deep in the money, take a loss, but if not, just roll it. Notice how simple this is. It's not a very complicated multi-page trade flow guide. uh, it's a simple one, but at least you have something to fall back on, and if things keep going wrong, then you go and fix your trading plan rather than feeling bad about the trades that might not have worked for you. Feel free to use this as a template, but then play with it and then come up with something. It can evolve, but let us have something in place before you go ahead on a full throttle. So happy and safe trading.